Okay, all right. I think we've got enough people in the webinar right now, so I'll start the webinar. So good evening, everyone. Thank you again for joining our mortgage webinar tonight. I am Karen. I'll be your facilitator this evening. So before we begin, I'd like to remind everyone to please turn off their mic and camera. And at the end of our webinar, we will have a Q&A session. So please take this opportunity to ask your questions to our host. And when you think of a question during the presentation, just feel free to throw them in the chat box and I'll read them to our host at the end. So, to kick things off, I'd like to introduce Ryan Lopez, our host for tonight. He's our senior mortgage loan officer at the credit union. So, with that, I'll have Ryan take over the floor now.
Good afternoon, everyone. As Karen said, my name is Ryan Lopez. I have been here with the credit union now for about 4 years. I'd like to welcome everyone on behalf of the credit union to our third annual Becoming a Homeowner webinar here. I always like to give a little bit of information about myself. I have been doing home loans here locally for 25 years, or as I like to refer to it, a quarter of a century now. And I've always worked with credit unions because they offer the best terms and deals for members, you know. So a little bit about me. I went to school here. I graduated from Bishop Gorman, went to UNLV. After college, I started working in the mortgage field. And when I first started, I kind of learned a lot from the manager who ran that department at the time. He was kind of like my mentor, and he taught me a lot of things about, buying homes and refinancing homes and renting homes, even buying and developing land and selling them, all that sort of things. And kind of with his knowledge and what I learned from being in the mortgage department, I was able to purchase my first home like a year out of college. And a lot of people think there's a lot of secrets to how to go about buying a home, or it's really hard. And I always say, to me, the home buying process is a lot like fitness, or trying to go to the gym and get fit or be slim or get stronger. There isn't really a secret to it. It's just consistency. And that's the same thing with buying a home, or buying a rental, or doing all this. You just have to stay consistent on what your goal is. So with some of that, we'll get started here, right? If you're looking at the slide, it says, becoming a homeowner webinar. We'll go into kind of some of the breakdowns of positioning yourself for home buying and how that all works. I would say there's three phases to buying a home, right? What most people think is the first phase is getting pre-approved, which is super important because that's when you're going to go out and get approved to make sure that your credit and your funds and your income and everything works for your pre-approval. Then the second phase is when you actually find a house and you're now in process to close on that house, right? But the phase that a lot of people neglect, or it's too late to do anything about, is the pre-purchasing phase. It's the phase before you've decided you want to buy a house. And that's a phase that a lot of people kind of run into hurdles with, whether it's, racking up a lot of credit card debt before you're ready to buy a house, or maybe you're paying an expensive rent, and so you're not able to put together enough money for a down payment to buy a house. Or one of the really important things is car payments can be really difficult in getting past when you're trying to buy a house, depending on how big of a car payment you have. So that's kind of the phase that a lot of people neglect, and you kind of wish you could get to them sooner and earlier to let them know, like, hey, don't, if you're in the market to buy a car and a house, like, buy the house first. Because after you buy the house, you can always turn around and buy the car. But if you buy the car first, it's very possible you're not going to get approved to buy a home. So now we'll move into different little steps here for home ownership, right? And these are just the different avenues that you'll be looking at. You'll want to save for a down payment and other costs that might be associated, like moving cost or closing cost, or any of those things. Address credit reports and your scores. You'll want to get pre-approved. It's super vital. Sometimes people will first see the home and then decide to get pre-approved, and that can be kind of heartbreaking because you'll find a house you absolutely love, only to find out like you can't qualify for it, and that's, we can save that grief by getting pre-approved first. Then you'll want to choose an agent, a realtor. There's tons of agents. You want to work with someone who kind of, meets your personality. Search for the property, then you'll choose the property. You'll submit an offer on that house. The offer will get accepted. You go into that escrow phase or the pre-closing period. And then once that's all done, you'll sign all your paperwork at the title company and get your keys. And that's a happy day, right? The ownership, right, is recorded. So if you're buying an existing, home that someone else lived in, they'll transfer the ownership from them to you. If you're buying from a new construction builder, the same thing happens. And then you can move into the home. So that's kind of the few steps there that are kind of nice and neat. So we'll start with kind of breaking down the first one, right? Saving for home ownership. This can be a little tricky, at times, depending on, if you're currently paying rent or not. You want to save for your down payment. You'll save for your closing costs. Closing costs can be different from one place to another. Some lenders charge really high closing costs, like if you're dealing with a broker or someone like that. You hear some places say they charge like 3% of the purchase price for closing costs, and that can be kind of outrageous, Then you've got your post-purchase reserve funds for some loans. After you buy the house, the underwriter may want to see that you have X amount of months of payments saved up in arrears, So, if hypothetically the payment's 2,500 for some borrowers or some programs, they may want to see that you have 2 months of reserve. So, $5,000 after you've paid your down payment and closing costs and everything needed to buy the house. If you're buying a rental, on some of those instances, they want 6 months. If you have a lot of property, sometimes they want you to have 6 months for every property you own. So that's stuff to keep in mind, which your loan officer will help you with, right? Repairs and renovations and furniture. So when you buy a new house, depending if it's a existing home, there may be some repairs you want to do. There's always some renovations. I always joke around that you'll get together with your realtor after being pre-approved, and you'll search and search for the perfect home that has everything you like. And then the minute you close, people immediately start changing everything. Let's change the flooring, let's paint, let's knock down this wall. And so there's always stuff like that. And furniture, if you haven't owned a home before, you'll have to keep in mind that, you'll want to buy some furniture that you didn't have, a living room furniture, dining table, all those things, right? Now, different ways to develop that savings is, of course, to, put yourself on a budget and try to regularly contribute every month to a fund. That way you can build that savings. That's where that consistency kind of comes into place that I was talking about earlier. You want to consistently kind of keep your mind on that prize and start putting in a little bit every month so that you can get to where you need, right? You can also utilize gift funds. So you can get funds from a family member and they can contribute gifts to you. And, all they need is a gift letter that they'll fill out, and then evidence of the transfer, and we can use that. You can also sell assets. And, if you own something that's a tangible asset, be it a car, jewelry, a collection, whatever it might be, you can use those items, you can sell them and use that to be your down payment. Just an example, I remember one time I had a borrower who was a sneaker collector, right? Sneakerhead. And he sold a couple of pairs of shoes. He sold like 4 or 5 pairs of shoes that were expensive collectible shoes, and that's where his down payment came from. And usually for something like that, all we need to do is be able to document it, get some sort of a valuation for it, document the sale, and you're good. I had a gentleman once who sold a family ring that had been in his family for I don't know, how long, and he sold this ring and got a couple of $1,000s, and that helped him with his down payment, right? The other thing that's also important to remember is retirement savings, especially 401k. If your employer offers a 401k, it's a good idea to contribute some funds to that because not only is it, in some situations, depending on your scenario, tax deductible, but you can also borrow from that to purchase a home. So if your employer is doing some sort of match or whatnot, not only are you getting like that 3% kind of bonus income every month from their match, but then you can use some of those funds to help you buy a home. So that's something that sometimes people forget about, right? And there's also some grants. There's a new one that just came out. It's a $50,000 grant. We'll go over that kind of towards the end, but if you have any questions, you can put that in the chat box too, and we'll go from there. And now let's move on to our next section here. So addressing credit reports and scores. This is kind of an important one, right? We had a couple of questions come in, beforehand when we were setting up how many people were going to be attending and sending out invites. And one of the questions that was asked is, what credit scores would prohibit you from being able to buy a home, right? So it depends on the program you're doing. So each type of loan, right? And there's a couple different types. There's VA, there's FHA, there's conventional, which incorporates Fannie Mae and Freddie Mac. They all have different requirements, right? So on here, we're seeing that, we look at the FICO score, and the FICO score is different than what you might see on like your Credit Karma, or what you might see, on if you're sometimes some of your institution or a credit card might have a credit monitoring service. And we find sometimes those are a little generous in what their scores actually are. Um, I think it's because they're consumer facing. So they try to limit the number of calls and complaints they might have about the scores not being as high as borrowers believe they should be. Your FICO score model ranges from 300 to 850, depending on the bureau. There's three bureaus. For a mortgage loan, we're required to pull all three. That's just what the government wants. And they will go not by your highest score or your lowest score, but they'll pick the middle one. If there are two borrowers on the loan, they're going to go by the lowest middle score between the two borrowers. And that's kind of what's going to determine your interest rate and your mortgage insurance and things like that, right? So many lenders require a score of at least a 620, and that's for a conventional loan. If you don't have at least a 620, Fannie Mae and Freddie Mac won't approve the loan. It doesn't mean that having a 620 will guarantee that you get approved, but it does mean that you'll, have a good shot of getting it. For FHA, they go down to about a 580. So you can go a little bit lower with FHA. Um, you'll want to check your scores a good amount before applying. Some people kind of want to wait sometimes. They don't want to have the hard inquiry on their credit score to see, what it's looking like and those kind of things. But it's something you probably want to do a few months before you're considering buying, in case there are any issues that pop up there. You want to have time to address what those issues might be. So that's what we're looking at when you're looking at, credit scores and the way those work, right? So tips for raising your credit score, of course, make your payments on time. That's one of the big ones. If, payments don't get reported late until they're 30 days late. So if you go past your due date, you'll usually get a little late fee or something along those lines. But if it's 30 days late is when it reports to the credit bureau. That will ding your score. That'll also make it harder for you to get a home loan, right? If you already have a home and you have a 30-day late on your mortgage, often that means you can't buy a home for a year. You got to wait 12 months from that late. It's not always the case. It can depend. Sometimes they allow for like 30-day late in the last 6 months, but it can vary depending on which agency we're using for the loan, right? Pay down balances. And this is a big one that a lot of people don't realize, but it's been a major component for a few years now. If you have a revolving credit line, like a credit card, it's the most common, right? But you can't have line of credits or overdraft protections, things like that. You'll want to make sure that whatever the limit of that account is, let's say it's like $5,000, you don't want the balance to go above 50% of whatever that limit is. The lower you can keep it, the better it is. And that makes up a big percentage of what determines your credit score. So if you have a lot of credit cards that are kind of over that 50% mark, they're gonna ding it as overutilization of credit, and you'll get a little ding there. There's a couple different ways. You can pay that down to get under 50%. You can also at times call whatever credit lender it is and ask them if they can increase your your limit. And sometimes that's a little way of bumping that up so you're not over that 50% mark, right? You want to keep, if you're looking at closing accounts, like maybe you've got a lot of accounts, you're not really using them a lot anymore or whatever that might be, right? You want to keep older revolving accounts you've had for a long time. So if you're looking at like, hey, I have this account and it's only 2 years old, but I have this other account and I've had it for 10, 15 years, whatever that might be, you'll want to close the newer one if you're thinking of closing any, because the more history you have with an account, the better it is for your credit score, right? And you want to limit credit applications, right? So this doesn't mean that when you're looking at getting a home, you don't want to apply a couple different places. Some lenders will tell you that, but they're telling you that because they don't want you to find a better deal, right? What this means is they don't want you to go out and apply for a lot of maybe like department store credit cards or a lot of different credit accounts. Sometimes you're making a purchase online, and you'll get like an Affirm thing coming up. If you get a lot of inquiries, that can also ding your score. So there's a thing there. Now, if you're looking at shopping around for mortgage loans, the bureaus recognize that you might be looking at more than one lender, just like you would if you're buying a car, right? No one goes to one dealership and picks out that one car and they're done. I guess it could happen, but for the most part, you're going to shop around and maybe go to a few different dealerships and see what they're going to offer. And of course, every one of those pulls your credit the minute you hand them your ID. And of course, even in that situation, the bureaus recognize, oh, they're shopping around for a vehicle. And a lot of times within like a 30-day window, it all counts as one inquiry. And it's the same thing with mortgages, right? Um, Now you want to check credit reports, like I said, a little bit earlier, a few months ahead of time, probably about 60 days. If there are errors, right? This used to be kind of an old thing. People would dispute the errors. Nowadays, you don't want to do that. We kind of want to investigate the errors. If you dispute the errors now, what often they make you do is take the loan out of the account out of dispute, and then we have to rerun your score. So you want to avoid disputing items. So if we pull your credit, this is where we want to pull credit a few months early. We can look at it, and there's an error on there, that we can kind of investigate what that was, see what the error is, and then talk directly to the bureaus instead of disputing it, because it won't solve anything. If you dispute, it's just going to show that you are disputing that account on there, right? And then non-traditional credit scores. Should you not have a credit score, there are ways to build a credit score for you. We can utilize things like rent or your payments to your insurance, utility payments, even like cell phones, Netflix, things like that. You can actually even self-report some of these with some of the bureaus, and that can help with your credit score, boosting your income and whatnot. And then when you go to apply, we won't count like your electric bill against you or whatnot, because it's a utility, and that's not something we factor into the debt to income ratio when we're qualifying you. The ratio limits already have those estimates built in. So it's not like we'll count it against you twice then, right? So let's see, going on to actually getting a mortgage loan, right? So sometimes you'll hear the terms about getting pre-approved and getting pre-qualified, right? Pre-qualified would be an example, like someone might call me on the phone. I get these calls all the time, and they'll say, Ryan, I'm looking to get pre-approved. How much can I get pre-approved for? And my response is usually, well, I can't really make that determination without looking at all your documents. Because there's certain ways that when we're looking at things, we calculate it differently than someone else might be. So sometimes, for example, I might have a borrower who says, I want to get pre-approved. And my first question would be like, okay, well, how much do you make? And they'll say, man, I make 180,000 or something. And I'll say, okay, great. What do you do? And they'll say, I'm a valet parker. I'll like pause. How much of that income is tip income? And they might say, well, on my pay stub, I have a salary of like 24,000 on my hourly income. And then I have tips that get reported in tip compliance of about 50,000 a year. But then all the rest is just cash tips. And in that scenario, I can only count what's actually reported on their pay stubs. I can count that hourly rate. I can count the tip compliance that's reported on their pay stubs and on their W-2s, but I can't count those cash tips unless they reported them extra on their taxes when they filed. And in that scenario, I can count them, but a lot of people don't do that. So that can be the trick with some of that. So that's just an example of why you want to get pre-approved versus pre-qualified. Because when you're getting pre-qualified, we're not looking at any of the documents. It's kind of just a rough conversation. And it's mostly just to kind of give you a ballpark idea, but it doesn't really carry any weight. You won't get a pre-approval letter. You can't use it to go shop for houses. Getting pre-approved then would require me actually pulling your credit, reviewing all your income documents, reviewing your bank statements, submitting a loan application so we can look over your job history, your residence history, all those details that kind of come into play, right? So, we'll be looking, we say like at your credit score, your assets, down payment, savings, retirement accounts, all that stuff counts, right? Employment history, income, any existing debt you have, right? We'll look at what kind of rates are at. And the tricky part here is when you're getting pre-approved or pre-qualified or whatever that might be, we can't lock in the rate. We can't lock in your interest rate until you actually have a home in contract. But we can give you an idea of like right now the rate's this. A lot of times when we pre-approve you, we're going to use a rate that's a little bit higher in case rates should go up. in the month or two it might take you to find a home, right? And then you'll get, like an estimate of what all the costs might be, how much you're going to need for closing. With us, just depending on the home you're buying, it can range anywhere from 5,500 to 6,500, depending on the type of loan you're doing, the taxes and insurance on the property, um, which title company gets used, all these things. There's certain costs that can vary and certain costs that can't. And so we'll kind of go over that when we're going over the loan estimate and how some of that stuff looks. But in terms of types of mortgages, there's a ton, and this is where it gets tricky on what might work best for your scenario. There's the fixed rate mortgage, right, which is kind of the bread and butter of the mortgage industry, especially post housing recession. Everybody usually wants a 30-year fixed rate loan where your principal and interest are the same. The interest rate cannot change. And while your principal and interest payment can change, your taxes and insurance can, because of course the taxes can go up on your home every year when they're assessed by the county. Your insurance can go up if like your insurance provider decides to increase your insurance. A lot of times if that happens, you can shop around and find another insurance provider, right? But the fixed rate, your principal and interest never change, and that's the majority of that payment, right? The adjustable rate mortgage gets a lot of bad rep, gets a lot of bad press and news. Largely, this was the cause of the housing recession in 2008. There was a lot of loans that were done out there with people thinking like, oh, I'll get this low rate for right now, and then later I'll refinance it, or I'll be making more, or whatever that situation might be. And it's not always the case. So if you do look at leaning towards an adjustable rate mortgage, you want to make sure that you can handle whatever the proposed future increases might be, right? Nowadays, we also treat these loans differently than we did back in 05 and 06 and 07, right? Now, when we qualify you for an ARM, we qualify you based on what we call the qualifying rate. And so we take into account that the rate may adjust in the future, and we base the approval on that. So they're a little less risky than they used to be, because now when we look at them, we do take that into consideration. So the idea is that if you could qualify with the qualifying rate, when the rate changes, you'll still be able to qualify for it. We have a special in-house ARM that we do. It's a 5.5. It's very popular. Unlike most mortgages now, which adjust every 6 months or sometimes every year, the 5.5 that we offer only adjusts every 5 years. And it's nice because you don't get that rapid increase. And we see some people use that for some terms, or some buyers that maybe they intend to pay off a house quickly, like within 5 years. And that's kind of a great option for them, right? So the ARM, right, offers that lower introductory interest rate, but it's usually for a short period. And it may be, not affordable as those payments increase. You got to keep that in mind, right? Interest only mortgage is similar. They come both in fixed rate and adjustable versions. And on this type of loan, you only pay the interest. So also precarious, because usually that interest only period is for a set amount of time. It might be for like 5 years or 10 years or whatever it might be. And when that time is up, now not only do you have to make the regular principal and interest payment, but you're operating on a shorter term. So instead of the balance being spread over the 30-year term, if you had 10 years of interest only, now you only have 20 years on that term, or 15 years on that term, or whatever that might be. And you have to start paying that back, and that payment can be aggressive. So as long as you know what you're getting into, you can kind of prepare and plan and know interest only isn't a bad loan, but you have to know and expect that change will be coming, right? There's also, other types of loans that exist nowadays. They don't really have any stated income loans like we had back in the era that kind of led to the recession. Those were a big part of it too. But what we do offer now, which is not quite the same, but kind of in that vein, is bank statement loans. And those are loans where they can look at your bank statement and look at your deposits and see how your deposits are moving. And they can use that sometimes to help qualify you. But those, lower documentation type loans where you're not providing pay stubs or W-2s or tax returns or things like that, they generally come with higher rates. So it's just something to consider if you're looking at something like that. And then let's move on to closing costs, right? So in terms of closing costs, these are just fees you have to pay to finalize the loan. When it comes to doing a home loan, there's a lot of parties involved between the lender, your realtor, the title company, the appraiser, the credit company that we pull credit from. If your home is in a flood zone, you may need flood insurance, right? In order to find out if your home's in a flood zone, we'll have to get a flood certificate, so we have to pay them to get that. So there's a lot of different little costs that are kind of built into this, right? Um, so you have your loan origination fee, and that's kind of an important one because this is the fee that is essentially coming from your lender. Some lenders charge loan origination in the form of a percentage, where they might say like, oh, there's 2 points or 1 point or whatever it might be. They may have like an admin fee or a processing fee or an underwriting fee, and those are typically all origination fees, right? Then there's also points, but these may not be points. This is where it gets a little tricky, right? These may not be points that are part of the origination. These might be points where you're using them to buy down the rate. Sometimes they refer to that as a discount point. And if the market rate, let's say, might be 6.875, you might tell your lender, I've got an extra couple of thousand to use. Could I buy down points? And then they come back and say, okay, if you paid, a 0.5% of your loan amount, that might get you from 6.8 to 6.75. Sometimes that's a small of a difference you're getting. Sometimes a 0.5 point might buy you more. Sometimes it might only cost an eighth. It can, just like the interest rate, the amount to buy down can vary just as much as the rates do. So in the morning, the rates and the points and the buy downs might be one thing. If the market is particularly volatile that day, the rates and the points and everything could be different later in the afternoon. I remember on 9/11, for example, the markets were super volatile because everyone didn't really know what was going on. And the mortgage rates and the points and whatnot, they changed like 5 times within the same day because it was just so much uncertainty in the air as to what was going to happen and what was going on, right? Your title fees, your title search, title insurance, those are all fees that are determined by the title company. The title company is traditionally picked by the seller. Now it's all part of the negotiation, so it can be negotiated. But depending on the title companies, they're all kind of the same. They all offer title insurance. The title insurance can be important because it's what's going to make sure there's no liens remaining from when the seller sold the house to you that were theirs, but they didn't pay, and now they've transferred to you, and somehow they didn't know about it. And it's kind of rare that something like this pops up, but it can happen. A common example might be like let's say the seller of the property was doing some sort of renovation, or maybe they had a plumbing issue or whatever it might be. Maybe there was some sort of dispute between the service provider, whoever did the renovation, or the plumber that fixed something. Maybe there was some sort of disagreement where the seller felt like the repair work wasn't up to what they expected, and they maybe are refusing to pay for part or all of the repair or whatever it might be. And then after that, the seller, just forgets about it. He decides to list the home for sale. He sells the home, but then whoever did that service goes and puts a mechanics lien against the property, and now you're the owner. If something like that comes up, that's where your title insurance will protect you. They'll come in and make sure that that's clean and there's no lien from the previous owner that you need to worry about. So that's why they use a title company. They're going to make sure all that stuff is set and everything's accurate, and you don't have any worries or concerns about that, right? The appraisal, right? The appraisals kind of work a little bit differently than they used to. Nowadays, we are not allowed to kind of communicate or even know who the appraiser is directly. As a loan officer, I'm not allowed to speak with them at all until we get the appraisal back. And that's also coming out of the housing recession, because prior to that, there was a lot of lenders and appraisers that would get together and kind of manipulate the cost of the appraisal or the home, the value. So nowadays, when we order an appraisal, it's sent out to like what we call an AMC company, an appraisal management company, and then they randomly assign an appraisal to go out and do the home inspection, and they'll contact the seller for an appointment if the home is occupied. If it's vacant, a lot of times the MLS listing just has like the code for the lockbox or the key inside it, and he'll have the code to go in there and access the home and just do the appraisal, right? And the appraisal is important because it's basically making sure that the home you're buying has the value, the collateral, essentially, that you're paying for it. If you're buying a house for 500, you don't want it to only be worth 450, right? So we're going to make sure that everything's okay, and the home has been looked over and the collateral is there. Now there are times where maybe we'll run the loan through whichever agency we might be doing with, and this comes up on conventional loans only, but on a Fannie Mae or Freddie Mac, it may be possible that they will look at the property and the address and all these things, and then they'll look at the value and they'll look at the neighborhood and they'll determine they are comfortable with the value as submitted and they don't require an appraisal. And in that case, you can waive the appraisal if you decide to, but you can also still get an appraisal if you want one for your peace of mind, right? So that's kind of some of the fun stuff with appraisals. Now, the other thing that comes along with appraisals, which we don't really deal with on the mortgage side, but we recommend is a property inspection, right? Notice it's not listed on these list of costs because it isn't something we require. It's just kind of something additional that you can do as a buyer for extra peace of mind. I highly recommend it because you never know what might be lurking in the property that you're not sure of. And sometimes not knowing can lead to a costly expense. The appraiser, when he goes through the home, he'll only look at like one burner to make sure gas is supplied to the house. He'll turn on one faucet and he'll maybe, turn on one light switch to make sure electricity and water and those kind of things are coming to the house. But he's not going to check every outlet. He's not going to check every faucet, right? This is where your home inspector comes in. That's what he'll do. And he'll go through the house kind of with a fine tooth comb and he'll look at every little thing and point out everything that might come up on the house and let you know. He'll look at the roof. He'll look at the attic, and he'll look at all those things, and kind of go from there. The inspection is kind of a major point of getting a home. You could have foundation issues, roof issues, electrical issues like your electrical box could need to be replaced, and some of that stuff could be expensive. So highly recommend getting that. The survey is kind of something that the title company will do. They're going to make sure that the land and everything is all measured out correctly and double check that. Recording fees are the cost that the county charges to record the new deed, so it's public record. And depending on the title company you use, it's not very much. It's usually X amount for the first page, and then I can't remember exactly how much per each additional page they charge, but often we see it be like $84 or something. But it can vary depending if you have a more complicated loan and those kind of things, but never too much, right? And your prepaid interest, right? Um, Mortgage interest is always paid in arrears. And you can usually when I'm estimating from somebody, we don't really know when they're going to close, when they're getting pre-approved. So I'll just estimate 15 days of interest to start because it's not too many days, it's not too little days, it's kind of right in the middle. And that'll give you an idea of like how much prepaid interest you get. This comes from the minute you close on the home, right? Let's say you're closing, January, or let's use the current month. Let's say April 10th, right? You're closing April 10th on your home. The minute that loan closes, the following day you start accruing interest, and interest is charged per diem. So they will charge that to you at the time of closing from the time you close to the end of that given month, and you'll prepay that interest. The following month, usually when you purchase a home, you normally skip a month. So if you closed April 10th, you wouldn't have a payment in May. Your first payment will be due in June. But the reason why is that mortgage interest is always paid in arrears. So June's payment is actually covering all the interest from May. And that's why even sometimes if you've ever owned a home or whatnot, when you go to pay off the home, your balance might say, oh, it's, I only owe $200,000 on my loan. But then you'll get the payoff and it's like 202,000 or some odd number. It's because they're adding in that last month of interest that hasn't been paid for the closing month, right? So that's kind of how all the costs work. Now, mortgage payment components, right? Like what makes up that payment? So of course it's the loan. You're going to have the principal amount. At the beginning of your loan, the principal amount is going to be pretty small. The majority of your payment will be interest. And as time goes on, the interest will decrease, but your principal will increase. And that's where you kind of want to, if you have the ability, you'll want to try to make some extra principal payments when you can. It'll really cut off a lot of your mortgage and the interest you'll pay. So often we'll say, like, if you can make one extra payment a year on a 30-year loan, on average, depending on your loan amount and your interest rate, you can reduce the term of that loan by about 8 years, approximately, right? Some people like to do biweekly payments, and they've heard like, hey, biweekly payments, save you a lot on your, mortgage interest and whatnot, and they do. But the trick there is that the reason they're doing it is because biweekly payments end up being, 26 half payments. And if you divide that by two, it's 13 payments. So it's the same thing as making one extra payment a year. What I usually recommend, if sometimes people will do the biweekly, just out of budgeting purposes, right? To say, hey, I get paid biweekly, so I want the payment to be paid biweekly too, and that works, right? Most mortgage payments are due on the first. You have a grace period through the 15th before it's considered late, and they charge you a late fee, right? So you can that kind of helps with the budgeting of your home loans, right? But you can accomplish the same thing even faster if you just took your monthly payment, divided it by 12, and then just paid a little extra each month of that amount. And in the same way, you'll be paying 13 payments a year, but you'll be achieving it a little bit faster because you'll be applying that to the principal every month instead of waiting till the end of the year like the biweekly payments does, you know. So the other thing that will make up your payment will be the property taxes. The property taxes are just dependent upon what home you buy, right? The older the home, the lower the taxes. The newer the home, the more expensive the taxes. The most expensive taxes you can get for your property is like a new build. They'll usually charge anywhere from like 1 to 1.25% for a new construction home, right? For older homes, one of the great things about being here is our taxes are low. So sometimes you can have taxes that are only like 2,000 a year or less, depending where you're at. Homeowners insurance also will just depend on what kind of coverages you want, right? If you're getting, basic coverages and kind of a regular deductible, homeowners insurance might not be too bad, right? If you're adding in a lot of policies for maybe like jewelry or an art collection or any of those things, of course, that could be a little bit higher. And the insurance is also based this on, area, distance to fire departments, distance to like fire hydrants, construction of the home, age of the home. And sometimes some insurance companies even look at the type of pet you have. Like if some insurance companies, if you have, one of the, what they consider to be like one of the 7 vicious breeds or, whatever that is, some won't insure you, so it just depends on a lot of that because for their purposes, they're looking at a lot of statistics and what's the statistical possibility that something might go wrong and they have to pay out a claim because, heaven forbid you pay insurance for years and years and then need them to pay a claim, right? And then mortgage insurance, right? So mortgage insurance is a little different. Some people sometimes will say like, why do I got to pay mortgage insurance? It doesn't really do anything for me. It just protects the lender. And to some degree, that's true, right? Mortgage insurance is basically just for the lender. If on a conventional loan, if you're not putting 20% down, you're going to have mortgage insurance. On an FHA loan, they'll charge you mortgage insurance no matter how much you put down. A lot of times, if you do the minimum down on an FHA, the mortgage insurance is for the life of the loan. So in order to get out of it, you'll have to, refinance into a conventional loan. And that can also mean getting a new interest rate. So if you have a pretty low rate, but now you can drop your mortgage insurance, but the rates are higher, it might not benefit you to refinance because now you're going to have a higher rate versus what you had. On a conventional loan, there are options to drop the mortgage insurance without refinancing. If the home drops to like an 80% loan to value with the value increasing, you can get an appraisal, and based on your lender's discretion, they can determine if they want to remove your mortgage insurance or not. Usually they want to see that you haven't had any late payments in the last 2 years, and that get an appraisal and make sure that's all there. And of course, if we're in an economic like downturn like we were during the housing recession, there wasn't anybody removing mortgage insurance during that time, right? The other option is that at 78% of the original purchase price, the MI will automatically go away. But that's not taking into consideration any increases in value. So since that's based on your regular amortization, like your regular minimum monthly payment, that could take sometimes 8 to 10 years to reach. And of course, if you do make extra principal payments, you can get there faster, right? So that's kind of mortgage insurance in a nutshell. A lot of people give it a bad rap. The truth is that if it wasn't for mortgage insurance, people wouldn't be able to buy homes without significant down payments, like 20% down or more. Mortgage insurance kind of came out of the housing recession. It was a Roosevelt kind of creation when he created HUD. And essentially was that during that time period, since everything was so economically depressed, no one could buy a house without putting a significant down payment. And 20% was probably light. It was probably more like 20, 30, 40, 50% in that era, right? And so what they did is they came out with this idea of mortgage insurance to allow people to buy a home because the government said we will insure the loan so that, this person can buy this home without needing such a massive down payment. So in some degree, mortgage insurance does help people out. They just don't kind of realize the benefit it's giving them, right? So finding a real estate agent. And this is always a fun one, right? You want to find a real estate agent that, is gonna, again, you want your personalities to kind of mesh, also, some realtors, work in certain areas. Some realtors specialize in certain homes, jumbo homes or, um, single families, multi-families. It just depends kind of what you're looking for. So you'll want to, when you're looking for an agent, you can ask for referrals. The credit union, we can always, refer some realtors that work with us or we've worked with in the past to kind of help you out. But you can also ask friends and family who they've had a good experience with. We really, as a lender, we're really kind of, um, you know, indifferent as to which realtor you use. You can use any realtor as long as you get along with them, they're fine with us, right? Um, again, agents that are familiar with the area you're considering, some agents, like I said, might specialize in certain property types. They also might specialize in certain areas. You might have some realtor who does a lot of transactions in like Road Ranch or in Henderson or Summerlin or the Northwest or, any of that. So sometimes that's a big thing. You want a comparison shop, what are some of the things that this realtor is offering you and not. There was a lot of um, buzz about some of the new legislation that came out regarding realtors and the split of commission or whatnot. Traditionally, the realtors are paid by the seller. Is how that's usually happened, but because some of the sellers weren't really informed that that was going on, there were some lawsuits about that, and now the way the realtors get paid is a little bit more negotiated between the realtors when you're making this offer. Um, and sometimes you'll see that certain realtors might tell you like, hey, like I only work for 2.5% or whatever it might be. And if the seller's not willing to pay me that, would you be willing to cover the other? If they give me two, would you be willing to cover the other 0.5% or whatnot? It's kind of rare. There was a lot of buzz about this and there was a lot of worry, but it really seemed like the status quo just remained. And for the most part, sellers are just paying both realtors like normal, but it is a situation you might run into. And so you want to keep that in mind just in case, because a 0.5% or 1% could be a lot of extra costs that you might have towards the end, right? And then you want to avoid using the seller's agent. Just like if you were going to court, you wouldn't want to use the other side's attorney. This is kind of the same thing. You want someone who has your best interest in mind. And if the seller's agent they're already in agreement and contracted to work for the seller, then that agent already has an establishing fiduciary responsibility to get the best terms and deals for their seller. It makes it kind of hard for them to kind of work in your best interest at the same time. So just something to consider when you're out there, right? It's not impossible, but it is something you want to keep in mind when you're looking for your realtor, right? And then we come down to like when you kind of start looking for a home, right? You want to consider what's affordable, right? It's hard to enjoy your house if you can't pay the mortgage. So this is, sometimes you're here to this referred to as being house poor. And this is a lot of lifestyle thing, if you are someone who maybe is more of a homebody, right? You might be like, I don't really want to go anywhere. I don't really eat out. I don't spend a lot of money. So since I spend a lot of time in my home, I'm fine with having a bigger house payment because I want to have a pool and a space to put a gym and a game room or whatever. Maybe you work on your cars and that's kind of a big hobby. So you want a nice garage that has a lift and air compressor lines and all that stuff running through it. Maybe you're really into a home gym or a sauna or you do yoga, all that stuff. Those are things you want to consider when you're looking at your house and what your budget is. If you're a person who maybe likes to take a lot of lavish vacations, right? Maybe you don't want a house payment that's as big as some others might be, because in that concept you might be like, I'm not going to be home a lot, I'm going to be traveling a lot, so I just want the house to be like a place I can live in and everything, but it doesn't have to have a super large payment, right? um or maybe you are someone who likes to have a really fancy car, right? But you're not so worried about your house. That might be a situation where you want to do that. I wouldn't recommend it. Cars depreciate and cars appreciate, but definitely something you want to consider when you're looking at your house, right? Create a budget, get an idea. What's important to you? What do you want? How much is the payment? Sometimes people will say, like, what's the maximum I can get pre-approved for? And I'll say, like, well, if I could put you in $1 million home, is that comfortable? Is that payment comfortable? And a lot of times they'll be like, no, that's too much, right? I'm like, okay, so what do you think? What's a good payment for you, right? So that's where you want to be at. Like, what's a comfortable payment? Some people, like if you're renting now, they might say, I want my payment to be similar to my rent, or maybe not a lot more than my rent. That's kind of a place to start. But there's all sorts of options when we're looking at pre-approving you, right? When you're looking at the home, don't forget to calculate, you know, other costs that you might not take into consideration, right? You're going to have your loan payment, of course, which includes your property taxes, your insurance, your homeowner's insurance. But you may also have things like homeowners association, right? If you buy a home that has an HOA, your payment will be, X, maybe it's 2,500 to your lender. But then separately, you might have to pay your association a certain amount, right? Some associations aren't very much. You might see some that are like $25. If you're looking at a townhome or a condo, those can start at 200, 250 a month, right? If you're in a gated community, those can also be higher. And some communities have not just one association, but they'll have like your community association, then the master plan association. So you're actually paying two. There was one loan I did where the home had three associations on it. So those are things you'll want to look at, plus maintenance, right? If you've rented before, you're probably unfamiliar with having to maintain things in the home. The landlord's likely been doing it for you, right? But you will have things like, um, if you have a yard, maintenance of the yard. If you have plumbing and something starts leaking, you'll have to maintain that. Depending on, some of the surfaces you might have, if you have tile or you have travertine tile or your countertops, those might require certain services. Even the surrounds in your showers, like they might require annual sealing so that they don't leak or they don't become more porous. So you'll just have to keep in mind that you'll have these maintenance items to keep up with. If you buy a pool, pools are great. If you have kids, they're fantastic. In the summer when my kids are out of school, they'll be like, Dad, we're bored. I'm like, you better go swim. That's what we have that pool for, right? But they come with maintenance, right? You can do it yourself. You can go out there and sweep the pool and clean the filters and do all that. But it is arduous. You can also, hire a company to maintain the pool. And even with all that, every couple of years, you're going to have to, replaster the pool every 10 or 15 years or so. They'll have to come in and jackhammer out all the plaster and put new plaster in. So those are things to keep in mind, right? When you're owning a pool versus renting, right? Owning a home versus renting, right? Decide what features you want, right? So when you're looking for a home, you get together with your realtor. One of the things you're going to discuss is like, what kind of home do you want, right? How many bedrooms? Do you need, are you just starting out? Is it just you, or you go with a one-bedroom condo, or do you need 4 or 5 bedrooms for your family, right? Might you need a next-gen home? Maybe you have older children that are in college but kind of need their own space, so maybe you get a next-gen home. Or on the other side of it, maybe you have the elderly parents that they can't live by themselves. You can have a next-gen space that has its own little kitchenette, has its own, entrance, all those things. Those are things to consider, right? Number of bathrooms. How many bathrooms do you need? The condition, right? Can you buy a home that's a little bit older that maybe has been a little neglected? And then you can do some of that handiwork yourself. Are you handy? Can you do those kind of things, right? Or, can you hire someone to do those things? Is that within your budget, right? Or do you need the house to be move-in ready? Sometimes we see this with young people who don't really have a lot of experience, maybe fixing things around the house or doing this things. They can't really move into a house and have a lot of repairs that they need to do later. So they need something that's a little bit more move-in ready, right? Size, how many square feet, right? Do you want, a 2,000 square foot house, a 1,200 square foot house? How much are you looking for? Yard size, right? Do you want a bigger yard, which you find more in older homes? Do you want a smaller yard? Do you not care about a yard? All those things come into play. What's the layout? Is it two-story? Is it single-story? Is it spread out? Is it a two-story? Do you have a bedroom on the bottom floor? Do you have the master on the bottom floor? Those are all things that can come into play, right? The outdoor space we kind of covered, lot size, pools, patios, balconies. What are you looking for, right? And of course, location. Like they say in real estate, right? The most important thing is location, location, location. So where are you buying? Do you want to be close to work? Do you want to be close to school? What about the school zone for your kids? If that's a concern, what kind of, what school do you want them to be in? Is it walking distance? Are there things close by? Are there parks? All those things kind of come into play, right? So now let's come over here to like types of homes, right? Your single family residence is just a regular home. Single family residence could be 2-story, 1-story, name it. There's some 3-story homes that we see sometimes, right? Then you have like your multi-unit homes, duplexes, triplexes, fourplexes, right? Four is the limit. You can't, anything beyond four is a commercial loan at that point. But these aren't bad options for sometimes first-time home buyers. You can buy a fourplex or a triplex or whatever as a primary residence and then rent out the other unit. And you can use the rent from that unit to help you qualify for the home. So that's kind of a nice thing. A lot of people don't realize you can do that, but it is an option sometimes for first-time home buyers. They can be a little bit more expensive, but with FHA, you can buy a fourplex with a little of 3.5% down. I believe now with conventional loans, they go to 5% down for fourplexes. So it used to be you had to do 25% on a conventional loan. So that's kind of a big welcome change if you're occupying it. PUD, or a planned unit development, basically just means it's a single family home, but it's in an association. So you have an HOA that's kind of governing the house. And some people like HOAs, some people don't like HOAs. I think the theory is decent. I think the execution is flawed at times with HOAs, right? But there's good and bad with everything, right? So it just depends. Some HOAs aren't an issue. Some of them are more a nuisance, so it just feels condominiums. Condominiums are kind of interesting. And there's a difference between condos and townhomes, and the difference is important. And the issue that you run into is that it's hard to get financing for condos at times. Not all condos qualify for traditional financing. It's because the government, like Fannie Mae, Freddie Mac, FHA, even VA, has particular rules that are extra for condos, right? You don't have these rules when it comes to a townhome. That's also why sometimes you will see a difference in the price of a condo versus a similarly priced townhome. A lot of times the townhome might be a little bit more expensive, and it's because it's easier to get a loan on that. Where sometimes on a condo, depending on the community, you can't get traditional financing for, right? I had a realtor who called me on a condo community, and I think the community had like 100 units. And for example, one of the rules is that one owner can't own more than like 20% of the units. And in this particular condo, one owner owned like 50% of the units. And basically, he was just buying them all up cash, because once you get over 20, then it's very difficult for anyone to get a loan in that community. And it just allows some of these investors to come in here and buy them cash. Now, there are programs out there that are called non-conforming condo loans. They do allow for lending on some of these non-conforming condo communities, right? Sometimes the rate's a little bit higher. We do some here at the credit union. It depends on a case by case basis as to why the community isn't conforming. And there's a couple different reasons. Sometimes, like in this scenario, one person owns too many units. Sometimes it's that there's too many rentals versus owner occupied units. Sometimes it can be, the HOA liens for too many months should the home go into foreclosure. There's a couple different things. Litigation, there's a litigation against the community, and a lot of times the government, like if there's litigation, they won't touch it. So those are the things that sometimes can be a problem with condominiums, right? But they're still doable. So there's some that are out there, right? Townhomes, like I said, they're kind of like condos, but you don't have all that extra community, worry about it. And the main difference between a condo and a townhome is simply that legally a condo does not own the land that it sits on. And on a townhome, you do. And that's kind of the big difference between those two properties, right? And then you have the last one is cooperatives. We don't see a lot of cooperatives here in Las Vegas. These are things you see more back east, particularly like in New York. And it's basically where, everyone kind of owns a portion of the building. And then, in order for you to even buy one, you have to be approved by like the owners of the building to move in there and become part of the cooperative, right? But it's not something common out here. So we'll go on to the next thing here, right? So the home search, right? The real estate agent's going to look up the home on the MLS. You basically tell them like, this is what I'm looking for. This is the area. This is the bathroom count. This is the bedroom count. They're going to punch that all into the system, and then all the homes that are available that meet your criteria are going to pop up. When you go look at the home, it's not a bad idea to take pictures. Some people forget to do that. You know what I mean? And it's good because, you might go see 3, 4, 5 homes in a day, and that might be over 2, 3, 4 days. And then later on the weekend, when you're reviewing them all, you might go like, which was the house that had that yard that we liked, or which was the house that had that cool den, or which, and so taking pictures kind of can help you remember some of that stuff later on. And then if you have like a little checklist, you can use that to like, oh, this has this has this. It kind of meets all our criteria. And it's important to remember that not every house is going to, is going to meet all your criteria. There's going to be, homes that, maybe 90% of what you want or 95% of what you want. But that's part of looking for the homes. You just have to look and see what meets your requirements, right? You'll make the decision of what's a want and what's a need when you're looking at your homes, right? I want a pool, but I need the home to at least have 5 bedrooms, something like that, right? You want to avoid being distracted by things that are easy to change, right? You might go into a home and maybe the flooring is outdated or something like that. That's an easy fix, right? The walls need painting, easy fix, right? But, more involved or material things you may not, want to take on. So that's where you want to keep in mind, like what's important and what's not, what can easily be fixed, what's just cosmetic repair, and what's going to maybe involve getting a contractor in to help you fix or remodel a bathroom or whatever, that might be, right? Visit a home more than once before you make that offer, right? Only because, maybe you go during the day when everyone's at work and you don't really get to meet the neighbors. But when you go later at night and the neighbors are home, you find out the guy next door likes to work on his motorcycle and he's, revving it every night, checking the engine and doing this and that. And maybe you don't want to live next to that. Maybe, you've got noisy neighbors. Maybe you've got, maybe you're near a school and you go during the day and it's not a big deal. But then when school lets out, there's a ton of kids in the neighborhood, that kind of thing. On the weekend, there might be more kids outside. Not that kids go outside much anymore, but you never know. There might be things like that and you want to consider it. So visit the home at different times of days, right? Flight paths could be a thing. Maybe you go during the day and you're under a flight path, but there's not that many planes flying by. But then you go later at night and there's a ton of planes flying by for whatever reason, right? Things to consider like that. So that's why you want to kind of visit it during different days. If it's raining, go by and see. You can double check like, hey, is the water pooling up? Is it kind of flooding here? Is there an issue that we got to consider? Things of that nature, right? Check out the homeowners association. That's kind of an important one. There's some things that you wouldn't realize that some HOAs don't allow you to do. My HOA doesn't let the garage be open if someone's not in there, which is just kind of a random, thing in my opinion. But it was funny because one time they sent me a notice and like, hey, your garage was open. And I was like in the picture, like I have a home gym like in the garage and they couldn't see me behind one of the racks. But I was like, that's me right there. Like I circled it. I was like, I was in the garage, right? So things like that, and you want to check. If you do like to work on cars, there are some places that have restrictions against that, right? If you have a commercial vehicle, a company vehicle, there are some places that won't let you park that in front of your house or on the street. So all sorts of things to consider when you're looking at homes and looking at the association, right? Then let's see, components of making your offer. You have the purchase price, of course, like how much am I going to offer for this home? You have the they might be asking 500. Maybe you think the home's only worth 490. That's where you'll kind of negotiate. You might offer 490, they might go back and forth. It just depends. Sometimes they'll say yes, sometimes they'll say no. You'll have things of that nature, right? Closing date. When are we going to close? Most closings are within 30 days of closing. But sometimes they might want a longer escrow. Maybe they want 60 days. Maybe they'll want to close in 30 days, but rent the house back from you for 2 weeks or 30 days. You have to occupy the home within 30 days of closing, so they can't rent it back further than that. But sometimes you have a scenario where someone is selling their home and they're going to buy a new one, but they were waiting until they were sure this whole, the sale was going to close. So then they get into contract, but they need a little extra time to move and do all that. That's where they might rent a property back from you, right? How long is the offer good for? When you make an offer, usually you want a response within like the next day, but that's also something that the realtor will kind of coordinate with you. Sometimes the seller might be like, we're reviewing all offers, on Friday by 3 o'clock. So maybe if you submit one Wednesday night, you might not hear anything back till Friday, but those are the kind of things, right? Concessions. Will the seller pay any of your costs for you? right? You could make an offer and say, hey, could you pay, 1% towards my closing? Could you pay 5,000 towards my closing? Those kind of things, right? You're not allowed to get any concession they give you back. So if they give you too much money in concessions, right, and it exceeds the amount of the closing costs, sometimes that money can just be left on the table and the seller gets it back, right? Sometimes we can utilize it somehow. We can buy down the rate or we can do different things to try and absorb it. But sometimes there isn't an option to do that. So those are things you want to consider and maybe even check in with your lender if you're asking for X amount of cost. Also, none of the seller's concessions can go towards your down payment. You have to come in with your own down payment funds. The seller can't provide any of that for you, right? But you can cover closing costs. You can get HOA dues, that kind of thing, right? Um, Now, inclusions. This is kind of like what items are the sellers leaving? This gets a little tricky. It's kind of a little gray and it depends on the underwriters. But for the most part, like furniture and electronics and things like that usually can't be included in the purchase price, right? They're usually called like an inducement to sell. And if they are leaving that and that stuff's included in the contract, then we need to get like an appraisal of how much that is and how much you're getting you because there are limits on how much the seller or the realtor or any interested parties can contribute. And any of that stuff like furniture being left or whatnot can be considered a contribution. So we'd have to look at it. Now, there are items that sometimes get left, like appliances. That's fairly common. Your kitchen appliances, washer, dryer, those things a lot of times are left. Sometimes we'll see kind of bulky, tedious items to move get left behind, like maybe they had an above ground spa in the back. That's considered personal property and not part of the house because it's an above ground spa and isn't permanently affixed to the house. It probably does have like an electrical connection and things like that, but you can just disconnect that and take the spa. So a lot of times they don't consider that, part of the home. They'll consider that personal property. But sometimes the seller will say, I don't want to move that thing. It weighs a ton. It's been there for years. I just want to leave it. And sometimes items like that can be left without attaching any value to it because it's just a matter of convenience to the seller. So we see that kind of thing, right? And then we come into like when you're making that offer, you're going to have contingencies in that offer, right? So you'll make the offer. They have X amount of days to get back to you. And once they agree, then the clock starts ticking. The first big one that we want to address is that often you're going to have 30 days to close. So you want to get everything moving. You want to get that contract over to your lender because that's when the green light goes off for us. We'll have 30 days from when I get that contract to get it closed, right? But you'll have like a due diligence period. A lot of times that's about 10 days. It can be different, it can be negotiated, but on average it's 10 days. And this is the time period that you have to check the HOA, check, get the CCNRs, check the rules that they have, make sure this is where you want to live, right? You'll want to get your home inspection done, make sure there isn't any mechanical problems with the home, make sure that's good, right? Then there's an appraisal contingency, which is separate. A lot of times that could be 14 days, 21 days, and that's how much time we have to get the appraisal to determine if the collateral, the value is there, right? If for some reason the home doesn't appraise, like you're buying it for 400 and appraises for 350, then there's usually three different things that happen. There's three avenues, right? One, the seller just lowers the price to whatever the appraised value is, right? Now, sometimes if he's already agreed to pay closing costs on your behalf or whatnot, he might remove that from the deal because he's getting $50,000 less, so he's not going to give you an extra 5,000 towards cost, right? That's all negotiable still, right? When you get that appraisal, you can go in and negotiate that. The other thing is the buyer can pay the difference. If you really, really like the home, maybe it's not a huge difference. Maybe you're buying a home for 400 and appraised for 398. You might say like, oh, I'll pay that extra 2,000. I really like the home, right? I think it's worth it. That's an option too. Just keep in mind that means you have to come in with that much more for closing because you have to pay that that 2,000. And we're basing our maximum loan to value, the 95% or whatever it might be for the loan off of that appraised value, not the purchase price anymore. So you'll have to do your regular down payment and come in with that extra shortage of the appraisal. The third option is if you can't agree, both of you can just walk away. They refund your earnest money deposit, and you go find a new house. Right? Sometimes you'll see this is a reason why some sellers don't want to accept certain types of financing on an offer. Right? Like FHA. You'll see some sellers go, we're not accepting any FHA offers. There's a couple different reasons that could be. Sometimes the realtors or the sellers just think like FHA is a lower quality borrower, which isn't true. There's different reasons to use FHA. Commonly, it's a program that's used for a lot of first-time home buyers, but you can use FHA to buy a new primary residence and move out of your old one, just as long as you meet all the criteria. And sometimes an FHA loan works out better for a client than a conventional loan. So there's different reasons why that might be, but the the appraisal on an FHA loan stays with the home for 6 months. So in the same scenario, if they were asking 400 and you got an FHA appraisal and it's 350, anyone else that comes along and makes an offer on that home using FHA has to use that 350 appraisal. So sometimes you'll see if they had something like this and they don't want to use it, they'll say no more FHA. We're only accepting conventional. That could be a reason. The other thing is sometimes FHA can be a little bit more particular about the condition of the home. And it's not anything major. A lot of times it's just like if you have paint peeling on the exterior wood trim of the door or the overhangs or the eaves of the house, right? FHA will require that that be painted because, of course, exposed wood can, rot and expand and swell, and so they'll have that done. So it's not a bad thing. It's really they're looking out for the buyer. So that's a kind of a great aspect there. And you see sometimes even with VA loans, there's some sellers that for whatever reason they don't want to accept the VA loans, and it also leads back to the appraisal in that scenario because VA loans are kind of similar. They have an escape clause where even if the appraisal comes in low, the borrower can get out of it even if it's past the appraisal contingency date. So there's things like that. So let's go to the next slide here. Making an offer, right? So now you found a house, you love it, you want to make an offer. Your agent is going to present the offer to the seller's agent. You're never really allowed to speak to the seller or the seller's agent. It's all done through the agents, right? It's customary to give the earnest money deposit with the offer. So when you write the offer, you're going to write in there how much of a deposit you're going to write to let the seller know you're serious about wanting to buy this house. And that can vary, right? Sometimes it might be like $1,000. Sometimes it might be 3 or 5. Sometimes if you really want to let the seller know that you're serious, you might give them a larger earnest money deposit. The deposit isn't an extra cost. It is just a deposit you're putting down, and it comes off the total you need at the end. So if hypothetically you needed, $20,000 to close, and you gave them a $5,000 earnest money deposit up front, well, now at the end you only need $15,000, right? So it's not like it's an additional fee or anything. That also happens with a couple of the other fees that you'll pay up front. Like if you pay the appraisal up front, that's going to come off of your funds to close. The appraisal can be like $500 to $700. So it's not huge, but it's not like you're paying extra on top of that. That will get removed from your cost when you pay it, right? I had a home I was buying once, just to give you an example. It was right down the street. I wanted to buy it for my mom, and another offer came in on it, and on that offer, they made an $80,000 earnest money deposit. And the seller went with them because they were like, well, they're super serious about buying the house because they put up $80,000, right? So that's just kind of an example of how that EMD works, right? The seller will either accept or reject or counter your offer. So like I said earlier, you might offer $490 on a $500 listing price, right? They might come back and say $495 or $498 or whatever it might be. That's where that kind of back and forth goes. Usually they'll counter, but if the offer is too low and they just don't imagine that the two of you can come to a accord, they might just reject it, right? Once the offer is accepted, it's binding. So you can't just back out for any reason. If you're going along and you've done your appraisal and you've done your inspection and you've done all your due diligence and you're getting closer to the end and you just get cold feet for some reason and you're like, I changed my mind, I don't want to buy the house, they can keep your earnest money deposit at that point because you've kept the home off the market. So that's something you want to consider when you're looking at a house. You want to make sure you really like it, right? Same thing with the seller. Seller can't back out, right? If they agree to sell you the house and you're in contract, it's not like they can get an offer from someone else and then say, oh, you know what? They're offering me 10,000 more. I want to go with them, so I'm going to cancel this transaction with you. They can't do that. It's a binding contract, right? So there's those kind of things. Now, if for whatever reason, let's say you had a 30-day escrow and there's some sort of delay or you can't close in that 30 days, and now you need to ask the seller for an extension, where at that point, you can be like, no extension. We're going to relist it. And that might be because they have a backup offer that's more or whatever that might be. It's rare. Most people will just extend the loan. They don't want to cancel because that means relisting it. putting it, back on the market, having buyers come and look at it again and going through that whole thing. And then they make an offer. And once that offer gets accepted, they're going to need another 30-day escrow. So in most cases, when you need an extension, the seller is usually more inclined to give you a week versus starting over and not knowing how long that might take, right? So going on to the next section here, pre-closing period, right? So now you're in escrow, right? You're going to have your inspection done that we talked about. You're going to check in with your lender, kind of see how things are going. If they need anything, they'll check in with you. A lot of times the processor, who is kind of like the loan officer's assistant, will reach out to you and let you know, like, hey, we need an extra pay stub, or we need a letter of explanation on a deposit we saw on your statements, or whatever it might be. Anything the underwriter needs, you'll get a notification from us. But it never hurts to just check in, make sure. You'll want to shop around and look at different homeowners insurance companies, right? Who are you going to use? If you currently are renting, you have renter's insurance, you can check with them. If you have your car insurance, you can check with your car insurance provider. We, again, are really kind of indifferent. You can use any homeowner's insurance company you want. And just keep in mind that the higher the premium is on your homeowner's insurance, the higher your payment will be. The lower the premium, the lower your payment will be. It's usually not a huge difference for the average home. You might be looking at a monthly insurance premium of about $100, so maybe like $1,200 a year. But they get lower than that, just depending. It'd be 800, 500, 600. I've seen some be as low as 300. It just depends on the home, right? And who you're getting it with. Some of them look at your credit scores for the insurance. All that stuff comes into play there, right? Avoid taking out any additional debt. This is a huge one, right? If you're in contract and we're underway to buy a house, you don't want to like go out there and be doing new credit inquiries. Like sometimes we see this around the holidays. Maybe you're Christmas shopping, you're at Macy's, and they're like, "Hey, you're making a big purchase. If you apply for our credit card, we'll give you 20% off today," or whatever it might be. Um, Doing that's going to ding your credit, and we're going to see it. One of the last things we do before we fund your loan is we do something called a credit refresh, where upfront when we pre-approved you, we pulled your credit, but at the end we're not going to pull new credit. We're just going to update the existing credit report we have, and we're going to make sure that there aren't new accounts that have popped up all of a sudden. You don't have new liabilities, right? No new credit cards. You didn't go out and buy a car. Don't do that. It's the kiss of death. It happens every now and then, even though we warn people. But don't go out and get a new car because we'll have to count that car payment against you. And if you don't qualify, guess what? No house, right? So you don't want to go through that whole 30-day period, not be able to close, and now you're in trouble. So don't go out and get any additional debt. Don't make any big plans for anything just yet. Like if you're renting, don't go immediately because you're in contract and put in your 30-day notice with your landlord, right? Sometimes there's delays. All sorts of things can happen. I've seen, a leak spring up in a bathroom as we're getting ready to close. And now the whole bathroom has to be redone because of water damage and all these things. And now the closing's delayed 2 weeks or so. But you put in your 30-day notice with your landlord, and now you've got to move out, and that creates a lot of unnecessary stress. So avoid, putting in your 30-day notice with your landlord. Avoid scheduling time off at work, super early, or scheduling movers. You'll want to wait until we're closer to closing to do that, right? And if two or more owners are going to be on the title, you want to kind of decide how you want to take title. There's a couple different ways to do that. The best thing to do is kind of talk to your title officer and tell them about your scenario. Most people do joint tenants, husband and wife as joint tenants. But sometimes you might see, like, a common example might be like a mixed family, right? You have a husband who's previously married and now divorced. You have a wife maybe who was previously married and divorced, and they have their each previous children from the previous marriages, and now they get married to buy a new house together. If you do joint tenants, then the surviving spouse, should something happen and one person pass away, gets transferred to the surviving spouse and they own it all outright, right? But every now and then you run into a situation where that happens, and then maybe the surviving spouse kicks the previous children from the other marriage out of the home, right? And so some borrowers will protect against that by saying, we're going to do tenancy in common, where 50% of the house is yours and 50% of the house is mine, and I'm going to award my house to my children should I pass away. Maybe I split up that 50% amongst them, or maybe there's a trust it goes to. but that 50% doesn't automatically pass to the surviving spouse. So things like that you can consider. And that's where the title officer will come in. They'll give you advice. They're the best person to talk to, right? And once kind of everything's ready for closing, after we've gone through underwriting, we got everything we need, we have what we call the clear to close, where the underwriter said everything's good, close this loan. You'll want to do a final walkthrough, right? Look through the house, make sure that there isn't, damage done when they were moving out. Make sure everything's still kind of working, because then you have time to get with your realtor. Your realtor will speak to their realtor and make sure to fix whatever might be wrong there. This is something that comes up also on rent backs. If you're gonna, let the seller rent the house back from you after you've legally become the owner, you also want to make sure maybe you have some sort of deposit or security deposit in case there's any damage, because otherwise you don't really have any recourse, right? Other than trying to take them to small claims court and whatnot, and that can be messy, right? So let's see. After our pre-closing period, you have like the day that everything is finalized, the title of the home transfers to you. You're going to sign that title. You can sign by notary also if you can't make it to the title company in person, but that's an extra cost, right? You know what I mean? For the notary to come meet you. But sometimes it can be convenient. I had a notary one time. I remember she reached out to me and she said, "Oh, I want to come by and sign this for this loan, this mortgage loan you're doing." And I said, I'm not, I work super late hours. I won't be available till like 11 or whatever it might be. And she said, "I can meet you at 11." And I was like, "Are you sure?" And she was like, "Yeah." I'm like, "That sounds kind of dangerous." And she's like, "Don't worry, I'm safe," and then she came by and we signed everything. So that's one facet, one way to get it done. I've had people sign kind of all over the place. Sometimes people go on vacation in the middle of their transaction and don't tell me, which is a surprise to all of us, because then we're trying to close and they're like, "Oh, I'm in New York, or I'm out of state, or I'm out of the country." And even there, we can have the documents, like email to where we're at, have a notary meet them, sign everything, and then they FedEx everything back to us overnight. So it's possible. I had that done even in a different country. But it can be difficult to do in a country because you have to find, usually you have to be near the embassy to have everything notarized, and it gets a little more complicated, but it can be done. So just, different ideas there. When you go sign, the loan's not quite done yet, right? A lot of times, depending on when you sign, the loan isn't going to fund and record the same day to transfer the ownership to you and all those things. A lot of times it happens the following day. So you'll go to title, you'll sign everything. They'll send us all the signed disclosures back. We're going to review everything to make sure it was correct. Nothing got mixed. There wasn't any error on it. We're going to make sure that like the deed is good and it can be recorded by the county recorder, because the county recorder is kind of like your old English professor, where if you typed up a report or a paper and the margins were off a little bit, they'll be like, "Oh no, we can't record that," right? So we're going to make sure that's all perfect. It printed out well. There's no notes or writing or things that they won't accept. And then we'll fund the loan. We'll go over the funding figures with the title company, make sure that all the numbers match. We'll send the wire over. We can only wire up until about, I think, like 2 o'clock, 2:30, kind of in that window. So if the funding is taking place after that, it has to happen the next day. And that's often why, depending on when you sign, you may not be able to fund and record and get your keys the same day. A lot of times it's the next day. And then before we fund, like I said, we do two things. We do that credit refresh that I mentioned. The other thing we're going to do often is a verbal verification of employment. During the transaction, we got all your documents. We got your W-2s, we got your pay stubs, we got all those things, and we looked at them. But prior to closing, we also have to make sure that you haven't changed employers. And so after you go sign, before we fund, you're going to pick up the phone, you're going to call your employer, and they're going to ask, "Hey, is Joe Smith still working there?" And they say yes. We go, "Great," right? But sometimes people don't realize this. I had an occasion once where a borrower went, signed, they thought everything was done, quit their job to start a whole new profession, right? We verified the next day she was no longer at her previous employer, and now it was a scramble to try to figure out how the loan would work, because she moved into a field where she was like all commission, and you have to have a 2-year history to count that, and it was a debacle. But luckily, we were able to like add her dad on the loan, really underwrite the whole thing, and then have new disclosures all signed at title to close, and then fund the loan. But you can imagine, we needed like a 2-3 week extension to make all that happen. And the seller was kind of livid, but it worked and we got the loan closed, right? Prior to going to title to close everything, you're going to get the closing disclosure. So this is kind of like the final version of the loan estimate that you're going to get when you start the loan in your initial disclosures. And it's going to have like what all the fees look like and all the costs. The Closing disclosure should not vary very much from your initial loan estimate. There are certain costs that aren't allowed to change at all. There are some that have a little bit of tolerance, maybe like 10%. And then there's some like taxes and insurance that, depending on who you decided to go with, can fluctuate, or how many days. Like we might have estimated, like the interest, for example, that I mentioned earlier. The per diem interest, we might have estimated 15 days, but now maybe you only need 5 days. So that will change. But maybe you went into the new month and you need something more like 29 days or 25 days. So those things are allowed to change, right? At that title, you're going to sign the note. The note's kind of what secures the loan. It has all the details of how much you're borrowing, what kind of term, how many years it's for, and what the interest rate is, right? The deed of trust is what secures the property, kind of says the property is yours, it's in your name. It gets recorded, it's public record. The closing disclosure, which is that estimate, there'll be a new, a final version of it there at title. And any affidavits, there's like name affidavits where you might sign any AKAs that might be showing like on your credit report. For example, officially, my name is Octavio Ryan Lopez, but Octavio's my dad, so I've always gone by Ryan since I was a kid. And but over the years, I've had different things show up on credit for whatever reason. Someone made a typo. In some things, my name shows up as Ryan Lopez. Sometimes it's Ryan O Lopez. Sometimes it's O.R. Lopez. So there's odd little variances that you'll see. I think at one point there was a typo made on some application that I submitted somewhere, and they have my name as, instead of Octavio, they have it as Ocativo. And I just laugh every time I see it, so it's kind of fun. But you'll sign all those affidavits, all the riders, everything that's necessary, all the government regulation forms, right? Now we get to like tax benefits, like why you want to buy a house. There's all sorts of reasons why you want to buy a house, right? Appreciation. A house you buy today for 400,000 and in a couple of years could be worth 800,000, right? It might take 5 years, it might take 10, it might go up to 800 and then dip down to 600 and then go back up. But over the years, historically, if you Google this, you can see this. If you look up what the trend is for homes, going back to however many decades, the 70s, the 60s, the 50s, whatever it might be, you'll see for the most part home values are generally rising with inflation. You'll see some blips, you know what I mean? Like in the 80s, we had 13%, interest rates on mortgage loans, 14, 15%, kind of outrageous rates. Lately we've had, a little bit higher rates than we had during COVID. That's kind of normal. You'll see some of that, but the interest that you're paying on your mortgage can be tax deductible. It just depends. There are some new limits that are coming into play. So depending on the total of your taxes, the interest, your property taxes, all that, they'll compare a lot of those itemized deductions against your standard deduction and see like what does it make more sense to deduct, right? If you have a rental property, like I've got a couple of rental properties, right? That's kind of looked at almost like as a business. So any expense that you have on that can be deducted. So that can be a huge thing. Like the HOA that you pay every month on a rental property can be deducted, where on your primary residence, it can't be deducted, right? Because that's just part of owning a home. Homeowners insurance, things like that. I can deduct those expenses on a rental, but you can't do that on a primary. So those are just the kind of things you'll look at, right? PMI can be tax deductible. There's different ways to take PMI. You could do a monthly, you could do an upfront single. If you do a single, a lot of times it's amortized over the life of your loan. If you do a monthly, then just a monthly amount you pay can be deducted. This is something that Congress actually like votes on every couple of years, where to continue allowing PMI to be tax deductible. And so far, it's been the case going back to like 2005 or so. They haven't changed that, right? Points, if you paid points to lower your interest rate, those can be tax deductible as well. But the same thing, they don't let you deduct them all in 1 year. You generally have to deduct them as amortized. So you have to deduct them over like the life of the loan that you have. And then if you refinance, and this gets a little complicated, right? But if let's say you paid points and you were deducting that over 30 years, but in year 5 you refinance, then in that year you can deduct the entire remaining points that you hadn't done on that amortization when you take the new loan out. It's complicated, but let's get together with your tax advisor and they can go over all that, right? Now your W-4, now that you're going to have some tax deductions, you might consider changing your tax withholdings, right? You might, if you were previously claiming 0, you might go up to 1 or 2, depending, because now you're going to have this tax deduction that's going to help you out with your home. It also works if you have rentals, that kind of thing. It could also be a consideration of how much you might contribute to your 401k. Maybe if you weren't doing your full match contribution, maybe your employer matches 50% up to the 6% you contribute, then but maybe you were only contributing 4, so they were giving you 2%. Now you might say like, oh, I got a bigger tax deduction, so I'm going to increase my 401 contribution to the max 6 and get the full contribution from my employer. There's all sorts of stuff, and again, that's something your tax advisor can definitely sit down and go over you with and let you know what the best course of action might be, right? And then that pretty much brings us to the end of the slide presentation. Now, the one thing I wanted to talk about that, is a little bit more involved, so I wanted to mention it here at the end, is that there are some grants available for first-time home buyers, right? There is a new one that's just come out as of yesterday. It's called the Mid-Income Grant. It will give you a grant of $50,000. You have to contribute $10,000 to get that. The grant doesn't have a retention period. So unlike some other down payment assistance programs where maybe you have to live in a home for 3 years or 5 years, or there's some that, the loan never gets forgiven. You have to pay it back after 30 years. This one can be, they forgive it right away. So, you'll get that 50,000. There's no requirement you have to stay in it. It has a qualifying income limit, right? So depending on who's on the loan and how many people are going to live in the house, there are limits as to how much you can make. But, the more people in the home, the more you're allowed to make. It's a pretty great program. You can use it for down payment. You can use it for closing costs. You can use it for buying down the interest rate if that's necessary, So there's a couple different questions. If you have anything there, just let me know. We're running a little bit low on time here, right? But if anybody has any extra questions or wanted to go over anything, my contact information is listed right on here. You can reach out to the credit union directly itself, speak to any of the loan officers, right? If we have 5 minutes, I might be able to run through some of these questions really quick and see if we can answer some of these, right? So I see early on here, Monique Cardenas asked, how many years of taxes do you need to provide for a pre-approval, right? Usually we're looking for 2 years for a borrower, right? But we don't always need tax returns. We usually only need it if you're self-employed or if you have rental properties. If you're just a W-2 employee, you usually just need 2 years of your W-2s, not the taxes, right? So let's see what else I have. What's the best mortgage type for a first-time home buyer? FHA kind of seems to be the best way, but that doesn't mean conventional can't be great either. A lot of times it depends on your particular situation, right? So one person might be better suited with an FHA. Another one might be better suited with a conventional. This is where your loan officer will come in. When you're selecting a loan officer, you definitely want a loan officer that has a lot of experience and can kind of walk you through all these different types of loans. Because there's some loan officers that, aren't very familiar with, one loan versus another loan type just because they haven't been around or done it long enough, right? One way you can tell is that all mortgage officers have a license number. It's called their NMLS number. The lower the number, the more experienced the loan officer, right? Like mine is a 6-digit number. I think right now we have people that have 8-digit NMLS numbers or 9-digit MLS numbers. So it kind of tells you how long they've been doing loans for, right? So let's see here. So here's a list of questions. I'll try and run through these here, right? How easy or likely is it for a student or someone who has student loans to get a home loan? It is possible. There's different things we can do, right, when we're looking at student loans. Now, if your loans are in forbearance or deferred and the credit report shows no payment for them, Fannie Mae, Freddie Mac, FHA, they all require me to count some sort of percentage against you to qualify, right? Now, on the conventional side, right, if Fannie Mae or Freddie, we're doing a loan with Fannie Mae or Freddie Mac, they do have a rule where if you have an income-based repayment plan in place, the payment on that plan could show as little as $1, and I'm allowed to use that. Otherwise, traditionally, I have to count 1% of those balances against you to qualify. That could be doable depending on your income, right? And if you're like a doctor or a physician that's kind of come out of school and you have a lot of loans, we do have a special loan in that situation where we don't have to count the student loans against you if you're in those fields, right? Now, the other question here is, do any of these loans apply to purchasing land or just already built homes? We do have land loans that we offer. Those aren't traditional Fannie Mae, Freddie Mac, FHA kind of government lending style, but we do here at the credit union offer land loans And we do offer construction. So if you wanted to do your own custom construction built home, you can do that. And we offer, construction loans with general contractors or owner builder. Just if you're doing owner builder, you have to have had some experience building houses, right? Or do you have to have a, project manager or a construction consultant or someone who's going to handle a lot of that for you. If you don't have any experience building homes and don't have anyone like that on your team, we won't do it as an owner builder. So, things like that to consider, right? Good way to purchase a home, though. It's a little involved, but a lot of times you can build a home for like 80% of what the value might be once it's completed. So it's a good route to go. Plus, you can make it however you want, right? You can add solar, you can add a pool, you can do all sorts of stuff, right? What are the options, pathways for people looking to purchase land and have their homes built? So we do that. We don't do any farming housing. So that's a whole other thing. You probably want to look at USDA. But if you wanted to, build a custom home here, we offer all that. It's a little involved, but like I said, it's doable. Is your income, if your income is dependent or independent contractor based, let's say someone income comes from content creation, what documents or proof of income would you need? So here, any type of self-employment, like where you're not getting a W-2, maybe you're doing your own business or you're a 1099 employee or whatnot, we consider that all to be self-employed income. So traditionally, they want 2 years of tax returns, which they're going to average, and they look at what your net figures are. So, if you make 400,000, but you end up writing all of that off with expenses and deductions, and it shows only 50,000, that's what we're going to use to qualify you at. So things to consider there, right? Can these loans be applied towards foreclosures, auction, or is that usually reserved for cash only offers? Yes. If you're looking at like auctions, they want what they call good funds. They want money on demand. You can't go there and auction on a house and win a bid and then be like, I'll get back to you in 30 days, right? So you can't do that. The foreclosures, if there's a home in foreclosure and it's been foreclosed on and the bank is selling it, you can definitely buy that. That's just like a regular sale. So there isn't any issue there. There's just not too many that we see right now, because a lot of homes have a lot of equity. So instead of going to foreclosure and letting the bank take the house, most people will sell the home and walk away with as much equity as they can, right? So we usually see that, right? Now this one says, lately I've been seeing a lot of finance by the owner notices on some properties with scammers getting better every day. Can we get your opinion on any guidance about these types of listings? So this kind of, if you're doing a for sale by owner, it's kind of what we refer to it as. It's not uncommon. You do see that. Sometimes the seller doesn't want to have to pay for the realtors, right? The only trick with listing it that way is that you can't get on the like broad source listings. So it's hard for people to see that the home is for sale. And, usually only people like in your neighborhood might be able to see it. You might be able to do some online listings, but not the common ones like the MLS, right? So the trick with that, if you see a for sale by owner and you want to make an offer on that, if you're getting a loan for it, we're of course going to check out a lot of the information on that. We're going to use a title company who's going to verify that that is the seller. And when you give the earnest money deposit, you don't give that directly to the seller, you give that to the title company, and the title company is going to make sure that everything's on the up and up. So that's where some of that will come in. But the ownership of homes is public records. So you can literally type in, you go to the county, assessor's page or whatnot, type in, the property address, and it'll show you who the owner is. You could always, if you're speaking to someone in person, you could always look at getting identification or whatever that might be that you might need, right? Rent to own vibe. So there are some rent to own that's kind of out there, but it's not too common only because it doesn't really work the way people think it is. When you're renting to own, the underwriters and like the government agencies, they will only consider the amount above fair market rent that you've paid to be applied towards the rent to own scenario. So it's a little weird, but let's say you're paying rent of $1,000 and that's the fair market rent. When you go to do the loan in a rent to own style, they will not consider any of the rent payments that you've made as going towards the purchase of the property or whatnot. But if the fair market rent was $1,000 and you were paying, let's say, $1,200, then that extra $200 a month that you've been paying can be applied towards that. What I see mostly is when we see like rent to own, what most people will do is just reduce the amount of the purchase price, or maybe pay some of the costs on behalf of the tenant if they were the landlord, that kind of thing, right? Are there any programs that you can join and complete to help with this process. I used to hear about them all the time when I was younger, not so much. I'm not 100% sure about which programs, but there are like first time home buyer education courses and whatnot you can take. When you apply for a loan, we are now required by the government to get, to hand out um, a booklet of all the first time homebuyer education programs that you can go and take. And they'll kind of walk you through it. There's some specialty programs like grant programs and first time homebuyer programs that sometimes require you to take one of these. Some of them are done in person, some of them are done online. Just kind of depends how you want to do it. They're not a bad idea. They're going to teach you kind of like budgeting and all those things, which are good, right? Um, let's see. Let me look at some of these other questions we have, right? Roughly, how old should accounts be? How long is the cool-off period when you're refreshing the credit? Every account should be at least 6 months old before you even think of starting this process. So this also depends, right? Let's say you are a young buyer and you don't have a lot of credit history. Even if you have some accounts, we might pull your credit report and not get any scores, right? It might say there's insufficient data because they haven't been around. So you usually, ideally, right? Ideally, like optimally, you would want to have, like 4 trade lines and you'd want them to be open for at least 2 years, right? However, that doesn't mean that you couldn't make something happen if you had maybe like a cosigner that has more experience credit on there, like a parent or a family member that could cosign. And that way, if you're lacking a little bit in credit strength, the cosigner can at times help you get pre-approved and go about that way, right? Um, the other thing that sometimes can be done is if you don't have a lot of credit, but you have a family member that trusts you and you trust them and yada, 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 they can add you as an authorized user on their account so that all of a sudden you've developed their credit history. And that's a possibility that you can do as well that can help improve your scores or gain you instant credit. It's also something that can be done to kind of help increase scores. If there's like credit issues or late payment history, sometimes adding some authorized user accounts from like a parent or a family member can help boost those scores for you, right? Um, so Raven, it says that you have a bunch of questions that you might want to copy and paste and email them to me. You definitely can. You can also call me. My direct cell phone is 702-815-5790. Yeah, it's shocking. I kind of put it out there. I give it to everybody. So don't worry. You can call, text me. It could be after hours, on the weekends, anytime. Like I'm always kind of working, so don't feel bad calling me, right? Let's see. Now, we had a question here that says, what are the requirements in order to be qualified in the program you just mentioned? So for the first time, the $50,000 grant program, there's an income limit. The income limit depends on how many people are going to be in your household. So this would be a question like if you want to know what that income limit is, you can give me a call and I can find out like how many people in your household, and I can look at that. There's a grid and we'll look at and we'll just see like, okay, you fall between this tier and this tier, so we can use that, right? You also have to be able to get qualified for the regular loan. So if you can be qualified for like a conventional loan and you have the necessary credit scores and the debt to income ratio, then that will pretty much, work. You have to be a first time home buyer, a couple of things like that, you know what I mean? But it's pretty straightforward for that program, right? Now, Raven is also asking, can the middle income down payment assistance that I mentioned be combined with other loan programs? Yeah, it can be. So, for example, right now we have a promotional rate where on our 30-year fixed conventional loans, we're offering a below market interest rate of 6.25, and that's without having to pay for any points. You could use that program with the mid-income program. If there is another program that meets the criteria, that's also a down payment assistance program, and you could use that. But sometimes the programs are different, so it would depend on which ones you're looking at to be able to combine them. But it does allow for layering of programs, right? Um, let's see what else we have here. If a spouse has a significantly lower credit, should they be on the loan, or what is the recommendation when trying to buy a house? This is a good one, right? So if it depends what type of loan you're doing, right? On a FHA or VA loan, if you are married, Nevada is a community property state. So those agencies will require that I pull the spouse's credit, even if they're not going to be on the loan. And if they're not on the loan, I can't count their income, right? But their score does not determine whether you can qualify or not. So, for example, on like I said, an FHA loan requires at least a 580, right? Let's say the non-purchasing spouse has a super bad score to like, I don't know, 400 or something, right? We don't want to put them on the loan because then we can't qualify. But I'll have to pull their credit And basically any debts they have that are in their own name, like if they have a car loan that's in their own name, I have to count against the buyer, right? But then I can't count their income. So it's kind of like a double-edged sword, right? Now, a lot of times, most people are kind of co-signed on everything together. And if that's the case, it's fine. That low score won't affect you. The only thing they're really worried about is there any additional debt there that may become the responsibility of the buying spouse? And if there is, I just have to count that against you to qualify. And if you can't qualify, we're okay. And there's been cases where we've done that, where, one spouse has really low credit, but the other spouse has good credit. Sometimes we pull the non-purchasing spouse. They don't have a whole lot of debt. They qualify just fine. You know what I mean? Sometimes they do have some debt, but the one who's going on the loan has enough income to cover it, and they still qualify fine. So it's one of the things you don't know until we look at it, but there is a way to still buy a house, even if a spouse has a low credit. On a conventional loan, they don't care about any of that. Fannie Mae and Freddie Mac, they're like, "Oh, you have a husband?" And then you're like, "Yeah." And they're like, "Oh, he's not going on a loan?" They're like, "Yeah." Like, we don't care. Right? They won't pull his credit. They won't ask. They won't look. They won't worry about any of that. So that's kind of one of the advantages. And that's why sometimes one loan versus the other, depending on your scenario, it might be a better fit for you, right? Do you have loans to buy properties abroad? We do not. We don't do any out-of-state lending. And currently, let me fix that. We don't do any international lending. And currently, we don't do any out-of-state lending. There are times in the past that we've done some. It goes back and forth just depending on what management, has a taste for at the given time. But sometimes we will there was a time we did all states. Then there was a time that we only did neighboring states. And then there was a time we only did a handful of states. But right now we're only lending inside Nevada, right? Let's see what. This is wait. I need that number one more time because you can see I'm very serious. No worries, Raven. My direct number is 702-815-5790. And like I said, you can text me on there. You can call me. I'm always kind of working, you know. Um, let's see. That's it. Yeah. Let me keep going here. There's a bunch about my phone number. Feel free to give me a call. I get lonely working sometimes, right? Just working away. But that's pretty much it. That seems to be all the questions we had. There were some questions that came in, like I said, on the registration for the event, right? So one was, if approved for a mortgage through CCCU, can the home be in another state? And like I said, right now we're not offering any of that. One question was about credit scores, but we kind of covered that. For an FHA, you have to have at least a 580. For a conventional, at least a 620. VA sometimes can go all the way down to 580, but sometimes they're only doing 600. So it just depends on the given time. But usually 600, 620, you're good with a VA, right? Someone asked how much down payment is needed. And this kind of varies on what you're looking at, right? If you are doing VA, they don't need any money down as long as you have your full eligibility, right? Some people believe that you can only have one VA loan at a time, and that's not true. You can have more than one. But on the second or third or fourth purchase you're making, sometimes depending on the area and what the maximum loan price is in that area, you may have to do some down payment, even with a VA, right? The other thing to remember on a VA is kind of old fashioned. So if you and your significant other are buying a house and you are not married, VA will require a down payment. Usually it's about 12.5%. But that kind of just depends on if the other person is not a VA or that kind of thing, right? And then let me see. For a FHA loan, they require 3.5% down. For a conventional loan, if you are a first-time home buyer, they allow 3% down. Otherwise, it's 5% down. A lot of people make the mistake thinking that you need 20% down for a conventional loan. You don't. That's where the MI helps you, right? So what are the best loan options and programs for first-time home buyers? Like I said, that just depends on your given scenario. FHA is popular with first-time home buyers, but we do plenty of conventional loans for first-time home buyers too. So credit scores and income. We talked about credit scores. Income is also kind of case-by-case basis. Sometimes people will call me and they'll say, how much do I need to earn in order to be able to buy a house for X? It's such and such amount. And I kind of have to jujitsu the question or judo the question and kind of throw it back at them and say, like, okay, well, how much do you spend, right? Because it's not only a question of how much do you earn, it's also how much credit liability do you have? How much are your minimum monthly payments that you're obligated for, right? I have seen people who have made a significant amount of money, you know what I mean? 50,000 a month, 100,000 a month, not be able to qualify because they have so much debt, right? And I have some people that maybe they're only making 30,000 a year and they're not debt heavy and they're able, they have some little savings, they can do a pretty good down payment and they're able to qualify for a loan that way. So it kind of, we don't look at any one thing when we're doing a home loan. We look at like 3 or 4 criteria, credit, collateral, is a house worth it, capacity, which means, can you repay this mortgage? Do you earn enough income? What are your existing debts? What's your credit history? All that stuff. And you can be strong in one area, like you can have a super low debt to income ratio, or maybe it's only like I only have a 10% debt to income ratio, but then your credit's a 400, like we can't do that loan. You know what I mean? So let me see if there's some other questions here. How do mortgage rates, closing costs, and property taxes work? We talked about property taxes. Rates are just kind of dependent upon the market. This is one of the things that's kind of really up in the air, right? I'm trying to get this one done before we have to get out of here, but rates are dependent on a lot of things. A lot of it's Wall Street, a lot of it's the Fed, a lot of it's the market. Traditionally, what you will see over at least in my 25 years is when the economy isn't doing so great and like Wall Street is kind of tumbling, rates will improve. When the economy is doing better and is stronger, you will see rates increase. And even that is not 100% accurate. Sometimes you'll see deviations from that. And it just kind of depends on several situations. So people will ask, do you think rates are going to go down? Or you think rates are going to go up? I say, I don't know. You know what I mean? I wish I did. If I did, I would use my crystal ball and wait and kind of, time the market. But, it really just depends on what's happening at that given time, right? During COVID, rates were super low. During the housing recession, rates were super low. During the dot-com bubble of like the early 2000s, rates weren't low. 9/11 rates weren't low. So it's kind of a crazy thing, but often when you're kind of wanting home rates to be low, you're kind of hoping for some sort of calamity to happen where the markets will tumble or something like that. The only issue sometimes that I caution people, they're like, I wish some sort of economic downturn would happen so that I could get a better rate, is you have to also remember, like, if there's an economic downturn, that also might affect your employment. You might get cut hours at work, you might lose work, which is things we saw during the housing recession, right? This is a great one. Is now a good time to buy a house, right? And my number one response to that is, if you are renting, it is always a good time to buy a house, right? If you live rent free, like maybe you're still living at home with family, then you can maybe consider like, maybe let me wait till I can save up a little bit more down payment. Let me wait till maybe rates get a little bit better. Let me wait till maybe prices maybe level out where it's not such a buyer's market. And I'm sorry, where it's not such a seller's market and I'm competing against multiple, offers to try and get a home. But if you're renting, it's always a good time to buy a house. If you don't own a home, buying a home is one of the biggest sources of generational wealth. A lot of people sometimes will say like, hey, I want to start a business and do all this. Like your first business priority should be own a home. You should be in the own a home business, right? Because once you own a home, you're not throwing money out the window for rent. Even though the majority of your payment early on is all interest, you are paying a portion of your principal. You get tax deductions. The home goes up in value. So there's so many benefits that owning a home really can improve your net worth and your financial position. And then you can even, once you have one, it's kind of easy to buy the other one. So you can then start, if you wanted to, you could build a rental portfolio. It's one of, I'm a strong proponent of homeownership. I definitely think that more people should be kind of educated and know how, you know what I mean? One of the things I said, like with my mentor, he helped me do a lot of stuff. By the time I was 28, I owned 3 homes, and it wasn't because of anything special. It wasn't because my parents gave me any money or whatnot. You know what I mean? It was just because I had the know-how. I was in the department. He was kind of teaching me, and it was just having that knowledge that kind of helped me accomplish some of that. I went to, like I said, I grew up here. I went to school here. One of the things I kind of tell people sometimes, I go like, when I was a kid, there was a point where like me, my parents and my siblings, we lived in one room for a while. all of us while my parents were trying to save up to buy a house. So I kind of remember that struggle, and for me, it's one of the biggest things to try and help people get into homes, because once you do, it's huge. um if I can offer any bit of advice, is try to stay away from like big car payments can be the kiss of death. I think there's been some reports and whatnot that have come out that said, auto loans and cars are the number two wealth killer in the United States. You know what I mean? The cars that, you'll buy expensive cars and they depreciate and all that money's just out the window. And then people will just turn around and just, it's kind of a vicious cycle of just keep buying new car every couple of years, and you never get out of that race and you're always paying it. I love cars, but I hate car payments. I have a car that I have been driving since 2005. It was getting along a little bit long in the tooth, and I was now getting to the point where I was, the maintenance and the work and all that stuff. I just didn't have time to do myself, and I went out and I bought the same car at the same age, but I happened to get lucky and find one that only had like 20,000 miles on it. Um, so keep that in mind, because cars are a major wealth killer. They can be a big detriment to trying to get qualified for a house. Often I see first time home buyers and they'll come in and they'll have $700, $800 car payments, and it's very difficult to kind of get out of that. And when you think that loan, like auto loans and auto purchases are the second wealth killer, the number one is divorce. So just think about how like cataclysmic and how hard a divorce can hit you financially. And number two is autos, like owning an automobile, having an auto loan. So if you can, try to avoid that trap of having to buy a new car every couple of years. Try to, not buy cars that have, high expensive car payments. And, that's basically it. You know what I mean? Let me know if anyone has any questions. Feel free to call me, email me. I appreciate you all being here. Hopefully, it wasn't too dry or too long winded, but it's an involved process. I'll let you guys go because we've almost been on here for about 2 hours now. But like I
Um,
said, any questions,
Sorry.
let us know.
Yeah, and then for everyone that didn't read my message in the chat, we'll have this recording as soon as tomorrow, and we'll also email everyone like the resources that we've discussed in this webinar. So yeah, again, if you have any questions, feel free to talk to Ryan, email, and call him at 702-815-5790. And do you have any last words, Ryan, before we conclude the session?
That's it, guys. Have a good night. Like I said, any questions, let me know. Stay away from car payments. If I can give you anything, it's that. Keep that in mind.
Okay, alrighty. Have a good night, everyone, and thank you again. Bye.
Okay, bye-bye.